Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our May monthly market update. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So before we begin with market information, I have two congratulations. The first of Valerie, who's been with us now for 7 years, advising our amazing clients. And also team member Eddie, who's been with us for 4 years, advising our amazing clients. So congratulations to both of those valued team members. It was great seeing many of you at our quarterly investment forum last month. We had over 100 attend at Perry's. Our next one that we'll be sending an announcement out in a few weeks will be July 24th, again, Wednesday at lunch. So we look forward to seeing many of you then. We also have an upcoming webinar on AI on June 26th at 11 a.m. Should have received the most recent notice about this just this week. So we look forward to many of you participating in that. Regarding markets, markets are now back to near all-time highs with the S&P at just over 5,200. We did have some pullback at the first part of Q2. But that's largely been erased, that 5 to 6% pullback. So we're now sitting near all-time highs in the S&P 500. We also have a benchmark as of this morning, which is Thursday morning, the 16th, with the Dow being over 40,000 for the first time. So one of the interesting things that's happened month over month is with inflation. This was a headline that we used last month where inflation came in hotter than expected. This month was the opposite of that. It came in a little bit lighter at 0.3 on the month and 3.4 annualized. The market overall liked this. Again, it was a little lighter than expected, and markets have so far traded positively in response to this. So following the CPI report, this was March, the rate cut outlook changed dramatically. For the June rate cut, now we're looking to September, maybe for the first one, and there may not even be one this year. This is a quote last month from the Minneapolis Fed President Neil Kashkari, who said there may not even be any cuts this year. So that's definitely something that's changed with the hotter than expected inflation number in March. The outlook for when rate cuts will begin and will that be in 24 at all remains to be seen. The average distance between the last raise and the first cut is about 11 months. The last raise was in the summer of 23. So we're getting very close to this kind of average time frame. And it looks like in this case, it's going to be longer. The April jobs report was good. It's kind of in that not too hot, not too cold, give or take 200,000 jobs number. Unemployment rate is just under 4. If this number was a lot hotter, that means inflation is more of a risk and the Fed is likely to delay cuts. So it's kind of right in there in that sweet spot number. We just are kind of at the tail end of earnings season, and 373 of the 500 S&P companies beat earnings expectations. So that's about 80% overall in Q1. So overall, that's positive for markets. Not everything is positive. The government is spending a lot of money. In fact, we'll talk about a not good benchmark that the federal government just achieved in the next slide. But basically, we're running deficits as far as the eye can see. The last time debt to GDP has been this high, we were fighting a war on two fronts in World War II. So this remains a big risk area. And this is the data point I was referencing, that the interest payments on the debt just reached $1 trillion for the first time. And you see how that's just moved geometrically up. So that remains an ongoing risk to be aware of. GDP has slowed, but it remains overall positive. So at this point, we've still avoided the recession. 70% of GDP is consumption, so how the consumer's faring is relevant. And by some measures, the consumer is starting to weaken a bit. Credit card debt reached 1.13 trillion in the fourth quarter of 2023. So the consumer and the health and debt service ratio and interest rates going up are all things to keep an eye on. Kind of that all being said, in summary, reasons for optimism. The recession continues to be delayed. The Fed does cut interest rates, which would be a tailwind for stocks. Market performance continues to widen beyond the mega cap tech and the Max 7, as it's referred to, in earnings season, which again for Q1 was overwhelmingly positive. Now I'm going to say optimism for an election year and also say pessimism because it's an unknown outcome at this point. Just the fact that it's over, and typically election years are positive, make it a reason for optimism. But I'll also start with it. It's a reason for pessimism. There's a lot of possible unrest. There's what the markets are expecting and then what happens. So I put that in the category of reasons for pessimism as well. Earnings, while they were good in Q1, could weaken. There's obviously geopolitical risk with a war both in Europe and in the Middle East at present. Another reason for pessimism is that the Fed just doesn't cut at all this year, and that gets pushed into 2025. The consumer that we've talked about continues to weaken as debt service required on their income builds, and that we do get the long-awaited recession. So a mix of things to both be optimistic and pessimistic about. One of the causes for optimism I mentioned in the presidential election year, we tend to get better performance in the back half of an election year, going back almost 100 years to 1926. We also get, this is kind of two different ways to look at periods of time where May 1 to October 31, that time frame on average is 4.3, and the time frame after it, November 1 through April 30, tends to be better. In an election year, those two are closer. So this May 1 to October 31 timeframe that we're in, on average, is up 6.3, and then the November 1 on in an election year, on average, up 6.9. And also just generally election years tend to be positive. So if we go back to 1926, we've got 7 out of 10 years are up. But in an election year, it's even more than that. So in the 20 presidential election years, 83% of the time up, 17% of the time down. So none of this is a substitute to contact us and discuss how all of these things apply to you directly and answer direct questions. So please reach out to us and leave no question unanswered. With that in mind, we'll close. Again, we want to thank you for the trust and confidence that you place in us. We hope to see many of you soon on a Zoom call in our office or at our upcoming quarterly investment forum in July. Until we see you again, be well and take care.